Hey, everybody. This is the Pearson Cusack Real Estate Group. I'm Shawn C.
I'm Jamie P.
And we've got a special guest for you today. It is our pleasure to bring Joe Parisi back on the Pearson Cusack Real Estate Group podcast of sorts. And we are excited to talk all things lending with Joe. We're going to touch on what's going on in the market, as I'm sure everyone has questions with these bank issues, rates fluctuating, all that kind of stuff. But we're excited to have Joe. So thank you, Joe, for being here. Really appreciate it.
Oh, I appreciate you guys having me on. Thanks for letting me join in again with your team.
Absolutely.
It's good to see you.
Last time we had you
Likewise.
on was during the pandemic. So for the people that didn't see that episode, would you mind giving us a little rundown on your bio?
Sure. I've been in the real estate lending world for 36 years now. I'm embarrassed to say. So started off with a bank, Citibank, long ago, and then went into the mortgage brokering business and mortgage banking. I'm now with Guaranteed Rate, and I've been with Guaranteed Rate now for 5 years. Previous company I was with a long time, like 17 years. And I have a family, 2 grown kids, 4 grandchildren. So they keep me busy.
Great. That's awesome. Thanks for that. So why don't we just jump right into it? Why don't we just kick it off with the bank failures? What's going on there? Could you break it down for us? And how are lenders looking at all that? And how do you think it's going to impact the market and buyers?
Absolutely. Thanks. So yeah, it's definitely the topic of the day. The last 5 days in the financial industry has been just utter turmoil. And I'll try and explain what happened first, which really, when you look at it, and I didn't make this saying up, I just heard it from another person in the finance world. It was really like a replay of the movie It's a Wonderful Life. That's what it breaks down to. Yeah. You know, the George Bailey's uncle lost $8,000, and that's depositors' money that they didn't have. So yeah. It's just like that. So first of all, just to let you know about how banks operate, and this might be basic, but basically they take in money and then they use that money to either lend or invest to make more money. It's an arbitrage thing. They take in, say, 100,000, and they'll pay you maybe 2% on a CD, and then they'll take that money and invest it or lend car loans, HELOCs, whatever you can think of, and hope to earn more than 2%. If they make 4%, they've made 2% on their money. What's actually not known to most is that 100,000. They don't have to keep that full amount in their teller drawers. So the requirement can vary, but it's 10 to 15% that they have to keep. So say they have to keep 10%. They keep that for people that want to withdraw money. The 90%, they go invest and lend and play with. Mm-hmm. So definitely a leverage move. They can make a lot more money by doing that. And they have that 90,000 to invest. What happened recently with the big one with Silicon Valley Bank, which, by the way, it was the biggest bank failure since Washington Mutual back in the crisis back in 2008. And to my surprise, I didn't know this. They were the 16th largest bank in the nation. That kind of blew me away. I didn't know they were that big. But they worked, primarily with a lot of the venture capitalists in tech. So that industry has been booming for the past few years up until now. So what Silicon Valley Bank did is something you would think was extremely safe. They invested that money, that 90,000, in the safest thing you could think of: U.S. Treasury bills, mortgage-backed securities. They didn't go make a crazy bet on something. They just put it in treasuries to try and get a return on it, which at the time were like 4 or 5%. So you think that'd be a safe thing, right? Nothing can happen. But what happens when you buy a treasury bond, say you buy a 10-year treasury bond, again, let's say 100,000, you buy that treasury bond and you're getting a 2% yield on it. So you get, 2,000 a year. When rates go up like they have, and this is where the Federal Reserve comes into play, because they're culpable on this thing too. When rates go up, which they did, like 5% on the 2-year treasury bill. So now I have this bill that's paying me 2%, or bond is paying me 2%. If I want to sell that thing, I have to sell it at a discount because the person buying it can go out and buy a brand new bond and earn 5%. So that $100,000 bond is now worth 70,000 because it's only paying 2%. So the 100,000 let's say the 100,000 you invested, if you were to try to sell that bond today because rates are higher, you're going to have to sell it for less. So that's what happened with Silicon Valley. The internals, when you looked at them, showed that as the Fed increased these rates so high, the values of their bond portfolio went way down. And coupled with, because they're in the tech industry, you've heard of tech with all the layoffs now, Meta, Facebook, every tech company you could think of is laying off people. So they're having some serious problems in that industry. And with that, they need cash. So they were withdrawing money out. So that's why it was kind of like the It's a Wonderful Life thing. They had a big draw on the assets. And then what happened is, which kind of tweaked it to where it was a big deal, was they realized they were short and they didn't have enough money if every depositor pulled their money out. So they asked the tech industry, the big venture capital people, I should say, not the tech industry, to buy some stock. They wanted to raise money by buying stock. That raised the red flag. Then everybody goes, they're in trouble. So then it was just, the snowballing thing, perpetual. So finally, the feds had to come in and say, look, your value is going down. You can't sell stock because people are scared. So we got to come in and make the depositors whole and shut you down. So that's in a nutshell what happened. And also with the other two smaller banks that went down, that's a similar situation too. So how does that affect us now in the market on home loans and mortgages? Well, it's a positive, even though it's really a disaster on their side. It's a positive because what's happened is the fear of contagion, which is this the only bank that's in trouble? Are we going to see, like First Republic has been in the news now because they're the next one that they say could go. So the contagion factor creates what's called a flight to safety, a flight to quality, which is investors say, I'm not going to buy stocks. I'm not going to invest in any companies. I'm going to not hold my money. I'm just going to put it in safety, treasury bills, mortgage-backed securities, which in the short term is a good thing. The bank thing was different, but so it's a flight to safety. But the bigger benefit on our part is now the Federal Reserve, they're caught. So they've been increasing rates to bring down inflation. And now they're going to have to pause. I mean, just a week ago, it was 80% odds that they were going to increase the short-term rate they have by 0.5%. Now it's 80% that they won't even go quarter. They're going to take a pause, which is great because what's happening there is we're going to see rates come down. The 2-year treasury bill had the biggest drop that it ever had. Was it yesterday or Monday? One of the biggest drops ever. It went like from a yield of 3.24 to 2.5. So it was a huge drop. So that's benefiting us with rates coming down. And a side note to that, the Fed, the reason they were increasing rates was to bring down inflation. We're finally seeing that they are being successful. We're seeing numbers on the economy that's showing inflation coming down. Today, the producer price index was a drop. So it was a negative. They were expecting a positive. So we're seeing good numbers there. So the combination of this bank failure contagion fear and the fact that inflation is coming down, we're, again, crystal ball, but as good signs that we're going to see rates come down even further from that little drop that they did over the past week.
And a great explanation.
Pardon me?
That was a great explanation.
Okay,
yeah.
thanks.
Really. I've been kind of trying to figure it out myself for the last few days here, 'cause it's kind of all these mixed reports, and it's obviously there's a little bit of in the news hyperbole and stuff, and you don't know really what you're reading into. So that was great.
Yeah,
Yeah,
and it's going to be contained because of the government's Credit Suisse today. They ran into a similar situation of the fear, and the Swiss national banks jumping in. So they're going to stop any kind of a massive default on banks. So and run, we benefit from this turmoil, in interest rates, I should say.
Got it.
So one of the challenges that this market has been faced with has been inventory. And so when you have interest rates that may be coming down, you have more buyers thinking, oh, I need to capitalize this and wanting to get in the market. And then we don't have any product for them to buy. And I see what is resulting, as in the last couple of weeks, is we're again seeing multiple offers, no contingencies being written, no appraisals and things like that, because there's not enough homes for these buyers, to buy. And I don't know how this all works itself out. I don't know what it, when the market turns bad, you can see sellers going, oh, I better sell because I don't want to give it all back. But we don't have those scenarios. So it gets to be a really interesting ride. And I described it the other day as when you go to the beach and you see multiple currents or tides happening. When we go to the beach, Joe, and you see that there's an incoming and an outcoming, and there are two different directions, and they start, you start getting waves going back the other direction. That's what the market feels like right now. It's kind of bouncing all over the place, and depending upon where you are, it's either good, bad, or really good for a seller, because sellers are reaping benefits again.
I hear you, and I think even though we're seeing that the multiples come back, I still think there's a limited window of opportunity for a buyer today, where relatively high rates still. They hopefully, like I said before, they'll continue to drop, but they're still, we're still in the sixes, and that obviously muted some of the demand, but it's going to change because when rates come back down even further, you're going to see that cycle where the limited inventory is going to cause the mega multiple offers, and you're going to see prices, start to fly again, and that's going to take some people out of the market. I know you guys know, the saying, marry the house, date the rate. So today you get in at 6.25%, 6.5%. But you get a home that, a year from now could be, 10, 20% higher. I mean, that's probably a little bit of an exaggeration, but if it gets like it was before, it could be. Even if it's a 5% appreciation, look at what you missed out on. That's a lot more than, a 1% difference in interest rate. And then, when rates come down, you refinance. So I think the opportunity is here for the next at least couple, 3 months for buyers to get in before it starts to go crazy again.
Good advice. That's really interesting. Want to know I'm sure buyers want to know what is Guaranteed Rate doing in terms of offering programs to help them get into property, help ease these higher interest rates. Are there things like that becoming available?
Yes, in fact, yeah. That the biggest concern of a buyer today, it's really not what my rate is; it's what's my monthly payment. That's what gets you to a comfort level to buy a home. And we have the standard rate buy downs where you can pay to buy down a rate as a buyer, a homeowner. I don't recommend that right now because of the fact that, like I mentioned earlier, you're most likely going to refinance whatever rate you get today in the next year or two with rates coming down. So if you pay a point or two, you leave money on the table. But if you can get a seller, if you can negotiate with a seller to pay for a rate buy down, then that's great, because it's basically you got that for free. And if you refinance, you didn't leave any money on the table. Also, we have some pretty attractive rates on adjustable rate mortgages, which are often called ARMs. We just signed up a new lending source, a bank actually across the country in Florida, but their rates are fantastic on the ARMs. We can get a 7-year ARM as low as 5.5% today. So that helps bring the payments down as well. And there's no prepayment penalty, so you can always refinance out of it.
Cool.
Great. So there's no a year later, not a problem, refinancing that loan or anything like that.
None whatsoever.
That's great.
That sounds like great. So what is our 30-year money pricing at right now for like conforming and then jumbo, to give them an idea versus that ARM?
Yeah, with 0 points, you're looking at anywhere from 6.25 to 6.625 on a 30-year fixed rate now. So the ARMs can give you a big advantage there. And an ARM, it's still a 30-year loan. It's just that you're fixed for an initial period, whether it be 5 years, 7 years, 10 years, and then it adjusts after that. But again, you can always refinance even during the fixed rate period. There's no restrictions on timing whatsoever. The other product that we have that's tied to the ARMs, it's not available on fixed, is the ARM with an interest-only payment option. And that's great because it can temporarily keep your payments even lower than it would be on a fully amortized, which is a principal and interest payment 7-year ARM. So the interest-only payment option loans allow you to get a payment that's quite a bit lower. And you're not paying down principal if you make that payment, but even on a 30-year fixed rate loan, in the first few years, you're paying down little principal anyway. So it's a huge advantage to get someone in today who realizes they're going to refinance into a 30-year fix when rates drop, which they will. The only question is when. But it gets you that comfort level to have that lower monthly payment. They're also ideal for people like all of us that are on fluctuating income, especially here in LA with the entertainment industry, where you have the cameramen, the actors, that they work from project to project, which we do quite a bit of loans for. They like the interest only feature because if they're on hiatus for a while, they can make that interest only payment. And then when they get on a new gig and they start making good money, they can pay down principal anytime they want to. There's no restrictions that you have to make that interest only payment. You can always pay down the principal if you want to. Other clients I have that love interest only loans are people that the high finance people that say, I'm going to take that money I would pay to principal and invest it, because I can make a better return investing it than paying down a 5.5% debt. So they're quite popular. They were restricted a bit in the last few years. By restriction, I mean you'd have to put a large amount down, like 25% or more. But this new source we have will allow us to do it with 20% down. So you can get an interest-only loan with a 20% down payment again, which hadn't been the case for like the last 3 years.
Got it.
And in worst case scenario, you have a 5-year ARM and it 5 years go by. It's already the adjustment where it would go. Is that already predetermined?
It's not, because it would depend on where rates are at the time. That's a good question. So after you're off of the fixed rate period, the interest rate is dependent upon an index that's a variable index, whether it be a 1-year treasury bill, the SOFI index. There's all kinds of indexes that banks use that will fluctuate year to year. And every year, it's an annual look they do. They see where that index is, and then they add a margin, which is a profit margin of, say, 2.5%. So wherever that index is at the 6th year is going to determine where your rate goes. There are caps to protect you. Like usually the initial cap is a 2% max you can go up. So there's not a huge payment shock. And then there's a lifetime cap. So if things went through the roof, you'd be capped out. which is usually like 5 or 6% above the initial rate.
No.
Got it.
Interesting.
I don't know if people, well, if you're as old as I am, then you may remember interest rates being 22 and 23% fixed. And I remember when I bought my first house, my first loan through Home Savings in America, which is no longer around, it was a 10.5% adjustable rate mortgage. So you guys, everyone thinks that this is horrible, but you know, we sold lots of homes back in the 1980s and at quite alarming interest rates back then.
I got you beat. My first was 12% initial rate on an
There you go.
Yeah. And I was so happy to have it, you know?
Yeah, absolutely.
First time home buyer. So you're excited to be a homeowner. Yeah.
I remember my dad having a 6% fixed rate loan, and I thought, God, we'll never see rates like that. And now we're complaining about them.
Yeah.
So do you guys do one of these 2-in-1 temporary buy down? And if not, what's your feeling on those types of loans?
We do. And that's where the seller comes in. If you can have the seller pay that. And it's to explain what it is, it's a temporary rate buy down. So by 2-1, it means the first year your interest rate is 2% lower than the note rate. So say, like I said before, you're at 6.25% interest rate where rates are at today. The first year you're going to get a 4.25% interest rate for the full year. The second year, which is the one part of the 2-1, it's going to go to 5.5%. So you have the 5.5% rate for the second year, and then the third through the remaining of the loan, you have the 6.25%. So it temporarily gives you a comfort level in moving into a place. Again, those are great if the seller can pay. Temporary buy down for a buyer today, it may work in some cases, but most likely not. It's better just to go with the 6.25%. But with what we saw, in the past 9 months, a lot of sellers were open to paying that, and it's relative to price too. You could say, I'm going to pay this a little bit more, but you're going to buy down my rate, and everybody benefits.
Yeah. Interesting. All right, cool. Well, appreciate all that. I think that it's definitely there's lots of questions answered for buyers out there. And if buyers are going, okay, great, this all sounds good, what's my next step? I know Jamie and I have talked to many of them, but what would you tell them at this point? Okay, where do I go from here?
Well, the first thing to do is to reach out to a lender to get pre-approved. It's, as you guys know, it's a prerequisite. When you put in an offer, you have to accompany it with a pre-approval letter. But just as important, or maybe more so, the first time buyer, it's an education process. You've never done it before. Most people don't do it that often in their lifetime, and you need to have the understanding of what you're jumping into. So not just getting pre-approved so you know what your max is, but getting pre-approved and knowing what your monthly payment's going to be, knowing what closing costs are going to be, knowing what property taxes, homeowners insurance. There's all that stuff that go into buying that you need to know about. So yeah, get pre-approved. And the people that are, especially first-time home buyers that are waiting on the sidelines, like I said before, this is an opportunity. Think about it. What asset can you buy with 97% leverage? You could do 3% down first-time home buyer. It's unheard of. And when you think about that, say you buy a home for $800,000 and you put 3% down, which is what is that, 24,000? Yeah, and then the property appreciates. Say it appreciates only 3%. You doubled your money in a year. Doubled it. So 100% return on your investment. You can't get that in any other asset.
Right.
So yeah, it's
and protect you from the rain and have a place to live and park your car and all those different things. That's so great about home ownership. Get off my lawn. That's my favorite thing. Get off my lawn.
Pride of ownership. Yeah.
That's cool. So, all right, very cool. So you're willing to, or essentially you guys can run someone through almost like a test scenario, if you will, sorts. Hey, here's what you're approved for. Here's what your payment's going to look like, so that they really get a full understanding of what they're getting themselves into.
Absolutely. Yeah. And sometimes what happens is I'll pre-approve somebody for X and then start showing them the numbers and they'll go, whoa, 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 whoa. I'm not comfortable with that. So we have to backtrack and go a little bit lower until they get to that comfort level.
Cool. Got it.
Got it. I was just thinking about, God, just had a great question. Darn it. It was my one great question. All right. Don't think of it.
Let me ask you this though, because I get a lot of it, and I know Jamie does too. We're at an open house. Have you been pre-approved? No, haven't been pre-approved yet, but I don't want to get pre-approved because I don't want to get my credit dinged.
That was the question.
I knew
Are
it.
you kidding me? Wow.
That was the question. They're always concerned about,
You guys have been working,
oh, they're going to pull my credit. I don't want to do that.
Listen,
you guys
Joe,
have been
we
working together too long.
we end up matching clothes more
Yeah.
often than we realize. And we're kind of
Working
all
together too
coordinated.
long.
Hey, wait, what?
That was a good question, Shawn. So there's a fallacy out there and a misunderstanding about how an inquiry hurts a FICO score. So when I get a lot of people that have the same concerns, I send them to the horse's mouth, the site of Fair Isaac Corporation, which is what makes the FICO scores. They have a piece on inquiries that says they're not going to affect your score. If it does, it's going to be nominal, like a couple points. So they shouldn't have that fear. And the other thing is, if they want to shop, if they want to go to multiple lenders, those inquiries, if they're within a 30-day period, they only count as one. So it's not like you have 6 inquiries that count as one. And finally, if somebody still isn't convinced, we can do what's called a soft credit pull, which doesn't put an inquiry on your credit report. It only gives us one credit bureau, so it's not as completely accurate, but at least we can still get them pre-approved off of a soft credit pull. So they don't have to have a hard credit pull if they don't, absolutely want to.
Cool.
Right.
Well,
That's cool.
yeah.
If they get a loan, does it then change their credit report then again? Like there are inquiries and you can see that they borrowed money, so somebody then approved them for a loan. Does that help their credit score?
It depends. It depends on the type of credit. Credit reports won't show whether you're approved or denied on a loan, by the way. Some people are concerned that, I got turned down by a credit card company. We won't know why. We won't know. Just the inquiry shows up. But yeah, if you have limited credit and you get an additional debt added, it's usually going to improve. So you're right, Jamie. It's going to improve your credit scores because you have more history of debt that you're paying on time. You want to have more of that. So yeah, that can be a benefit to you for sure.
Cool.
Cool.
Well, you got anything else, Jamie?
I could sit here with Joe all day long and talk real estate and lending and loans because it's so friggin' fascinating. So let me come up with some other good questions. No, actually, we know that what he does for a living is actually get people loans, and so he's taking time out of his very busy day, and we truly appreciate that. I want to comment about the surfboard behind you. Are you a surfer?
I am a surfer. Yeah. Yeah, I try to get out.
Wow.
A couple times a week, usually.
So you big wave guy, or yeah?
Oh no, please. I'm an old man, longboarder. The longer the board, the better, the more efficiency. Yeah.
That's awesome. I love that about you.
Well, yeah, you do too. I mean, at least you used to, I know.
I haven't been in the water in a long time. It's cold. I don't know if you know that, but the water's cold.
It's icy right now. Yeah.
And it doesn't work with this old tired bones anymore. That's not great. So I'm glad you're still out there.
Well, you have to join me in the summer when it's a little warmer.
Yeah. All right. It's a plan. It's a plan. Shawn gets in the water too. Now he's ripping it up.
No, really?
Yeah. No, I wouldn't say ripping it up, but I've been trying to get back out there.
All right.
This is Hollywood. We can say whatever we think we need to say.
Mondo's is my spot.
All right. We're gonna all get out there.
That sounds good.
Yeah, well, because I think he surfs Ventura, which is where you go, right?
Oh yeah, that's exactly where I'm at. Yeah, yeah.
Cool.
Yeah. So we'll make that a plan.
All right.
So Joe, if someone wants to get pre-approved with you, I mean, we know how to get in touch with you and all that, but do you want to let people, know your information, kind of promote that a little bit?
Yeah, my website is one source that's easy. I usually prefer at the initial contact to be a phone call.
Cool.
It's more personal, and I can at least get an idea on what people's goals are, their dreams are, what they're trying to do. So phone call, my cell's always on, obviously. I don't know if you need to give that out or what, but
well, you know what we'll do instead? We'll put that in the information below. So if you want to reach out to Joe for that initial phone call, which I've had buyers, we both had buyers do, and it is a great process because it is personal, and I think it helps really build a plan. So we're going to put Joe's contact information below. So if you want to reach out to him, look for it there, or of course reach out to us and we will put you in contact with Joe. Great guy and definitely knows his stuff. So we're gonna
absolutely. Joe Parisi is a Pearson Cusack approved vendor.
That's right.
No, I appreciate you guys having me on, and you guys are the best. Just enjoy working with you.
Same here. Awesome.
Well, thank you everybody for watching. Thanks again to Joe Parisi for his time and knowledge. We appreciate that. Hope it broke down a little bit about what's going on in the banking industry and helped to clarify that kind of stuff. Also, hope you learned something about the credit pulls and what programs Guaranteed Rate has to offer. I think there's a lot there for you. So if you have questions from here on out, again, contact information below. Reach out to us anytime. Other than that, we hope you have a great day. Thanks for watching.
Cheers.
Bye-bye.